Consider two hypothetical shops, Shop A and Shop B, both offered for sale. Shop A is priced at $100,000 and generates an annual income of $10,000. Shop B is priced at $300,000, yet also generates an annual income of $10,000. Both shops yield the same absolute annual earnings despite their differing prices. This comparison highlights a fundamental difference in the value proposition of each investment. It illustrates how identical earnings can be associated with significantly different asset valuations. Investment decisions often involve comparing options to identify the most favorable choice. Consider Shop A as an example, chosen for its lower cost relative to its earnings. This principle of comparing cost to earnings is fundamental in financial analysis. The price to earnings (PE ratio) is a key metric used in the stock market. It helps investors make similar informed decisions by evaluating a stock's value relative to its earnings. The price to earnings (PE ratio) is a fundamental metric used in stock market analysis. It serves as a crucial tool for investors to evaluate the valuation of a company's shares. The primary purpose of the PE ratio is to help investors avoid overpaying for a stock. By comparing a company's share price to its earnings per share, it indicates market expectations. This discussion will define the price to earnings (PE ratio), a key financial metric. We will address common misunderstandings regarding PE ratio, especially among novice investors. The application of PE ratio by value investors to identify undervalued stocks will be explored. Understanding PE ratio helps in assessing a company's valuation relative to its earnings. Strategic use of PE ratio can prevent overpaying for stocks, enhancing investment decisions. This overview aims to provide a comprehensive understanding of PE ratio for informed investing. The PE ratio stands for price to earnings ratio, indicating its core components. It is a fundamental metric used in financial analysis to evaluate a company's valuation. The price component refers to the current market price per share of a company's stock. The earnings component represents the company's earnings per share, EPS, over a period. The ratio is calculated by dividing the stock's market price per share by its earnings per share. A higher PE ratio can suggest that investors expect higher earnings growth in the future. The price to earnings (PE ratio) is a key financial metric used to evaluate a company's valuation. It quantifies how much an investor is willing to pay for each dollar of a company's profit. The PE ratio is calculated by dividing the current share price by the earnings per share, EPS. A higher PE ratio suggests investors anticipate higher future growth or perceive lower risk. Conversely, a lower PE ratio may indicate undervaluation or expectations of slower growth. The price to earnings (PE ratio) is a fundamental valuation metric in financial analysis. It helps investors assess the value of a company's stock relative to its earnings. The PE ratio is calculated by dividing the current stock price by the earnings per share, EPS. Stock price represents the market value of a single share of the company's stock. Earnings per share, EPS, indicates the portion of a company's profit allocated to each outstanding share. Earnings per share, EPS, is a key financial metric for companies. It represents the portion of a company's profit allocated to each outstanding share. Specifically, it applies to each share of common stock. EPS is calculated by dividing net income by the number of outstanding shares. This metric indicates a company's profitability and is vital for investors. The price to earnings (PE ratio) is a key financial metric used to value a company. It is calculated by dividing a company's current share price by its earnings per share, EPS. Consider a stock with a market price of $100 per share. If the company's earnings per share, EPS, are $10, the PE ratio is $100, $10, indicating investors pay $10 for every $1 of earnings. The price to earnings (PE ratio) is a fundamental valuation metric in finance. It indicates the amount an investor is willing to pay for each dollar of a company's earnings. A PE ratio of 10 signifies an investor pays $10 for every $1 the company earns. This ratio helps assess if a stock is overvalued or undervalued relative to its earnings. Consider a friend who owns a small business, a tangible asset with inherent value. This business consistently generates an annual profit of $5,000, representing its income stream. The friend decides to sell this business, initiating a transaction. This scenario serves as an analogy for understanding investment and asset valuation. The price to earnings (PE ratio) is a key metric for valuing a business. It compares the market value per share to the earnings per share. If a business is priced at $25,000 with earnings of $5,000, the PE ratio is calculated as $25,000 divided by $5,000, resulting in a PE of 5. The price to earnings (PE ratio) is a key financial metric used to evaluate a company's valuation. It compares a company's current share price to its earnings per share, EPS. A PE ratio of 5 indicates that an investor pays $5 for every $1 of earnings. This ratio can also be interpreted as the number of years it would take to recover an investment. Assuming constant profits, a P/E of 5 implies an investment recovery period of 5 years. This metric is crucial for investors to assess potential returns and investment timeline. The price-to-earnings (P/E) ratio is a valuation metric used to compare a company's share price to its earnings per share. In this scenario, we consider a business with an assumed earnings of $5,000. If the asking price for this business is $100,000, this figure represents the price. To calculate the P/E ratio, the price, $100,000, is divided by the earnings, $5,000. This calculation yields a P/E ratio of 20, indicating the market's valuation of the business. The price-to-earnings (P/E ratio) is a valuation metric used to assess a company's current share price relative to its per-share earnings. It indicates how many times investors are willing to pay for each dollar of a company's earnings. A P/E ratio of 20 suggests that an investor is paying 20 times the company's annual earnings per share. This ratio can also be interpreted as the number of years it would take to recover the initial investment. Thus, a P/E of 20 implies a 20-year investment recovery period. Assuming consistent annual profits, the price-to-earnings (P/E ratio) is a key metric for valuing a company's stock. It compares a company's current share price to its earnings per share. A P/E ratio of 5, for example, indicates a lower valuation relative to earnings. Conversely, a P/E ratio of 20 suggests a higher valuation. A lower P/E generally implies a cheaper asset. The interpretation of price-to-earnings (P/E ratios) is often complex and not straightforward. A simple P/E value alone may not fully capture a company's financial health or investment potential. Numerous other factors significantly influence the true meaning and implications of a P/E ratio. These influencing factors can include industry growth rates, company-specific risks, and market sentiment. Economic conditions, interest rates, and accounting practices also play a crucial role. Therefore, a comprehensive analysis requires considering these additional variables alongside the P/E ratio. Beginners often seek a definitive, best price-to-earnings (P/E ratio) for investment decisions. This search for a single ideal P/E ratio can lead to significant confusion. The concept of a best P/E ratio is misleading, as its value is highly contextual. A P/E ratio's interpretation depends on various factors, including industry, growth prospects, and market conditions. What is considered a good P/E ratio for one company may be poor for another. Therefore, a comprehensive analysis of the company and its environment is crucial. The price-to-earnings (P/E ratio) is a fundamental metric for valuing a company's stock. A good P/E ratio is not a fixed value, but is highly dependent on various influencing factors. Industry benchmarks play a crucial role, as different sectors have distinct average P/E ratios. Company-specific growth prospects significantly impact what constitutes an acceptable P/E ratio. The overall economic climate and prevailing interest rates also influence P/E ratio interpretation. Therefore, assessing a P/E ratio requires a comprehensive analysis of its specific context. The price-to-earnings (P/E ratio) is a key metric for evaluating a company's stock value. General guidelines help investors interpret P/E ratios. Though industry variations exist, a P/E ratio under 15 is often considered to indicate a potentially undervalued or cheap stock. A P/E ratio between 15 and 25 typically suggests the stock is trading at a fair value. Conversely, a P/E ratio above 25 may indicate that a stock is potentially expensive or overvalued. The price-to-earnings (P/E ratio) is a key metric used to value a company. It compares a company's current share price to its per-share earnings. A high P/E ratio often suggests investors expect higher future earnings growth. Some companies warrant a high P/E due to their rapid growth potential. These companies are anticipated to expand significantly, increasing future profits. Investors are willing to pay a premium for this expected future growth. A fast-growing technology company often exhibits a higher price-to-earnings (P/E ratio). For instance, such a company might have a P/E ratio of 40. This higher P/E reflects investor expectations of significant future earnings growth. In contrast, a traditional, slower growth company typically has a lower P/E ratio. A slower growth company might have a P/E ratio of 10, indicating more stable, mature earnings. Price-to-earnings (P/E ratios) are a key metric used to value companies. A high P/E ratio indicates that investors are willing to pay a premium for a company's stock. This is often seen in growth companies, where current earnings may be modest. The elevated P/E reflects strong investor expectations for significant future earnings growth. Therefore, High PE ratios are a direct indicator of market confidence in a company's future prospects. The price-to-earnings (PE ratio) is a fundamental valuation metric in financial analysis. It is commonly understood as a measure of a company's current share price relative to its per-share earnings. However, the PE ratio serves a deeper purpose beyond merely indicating price. It also functions as a powerful reflection of market expectations for a company's future performance. A higher PE ratio often suggests that investors anticipate strong future earnings growth. Conversely, a lower PE ratio may indicate more modest growth expectations or perceived higher risk. Value investing is an investment paradigm focused on identifying undervalued assets in the market. Its core principle is to purchase high-quality companies at prices below their intrinsic worth. This strategy aims to minimize investment risk by creating a margin of safety. Value investors conduct thorough analysis to assess a company's true value, irrespective of market fluctuations. They seek out businesses with strong fundamentals, sound management, and sustainable competitive advantages. The objective is long-term capital appreciation through patient investment in fundamentally strong, undervalued entities. Value investors strategically seek companies that are undervalued by the market. They prioritize businesses demonstrating consistent and stable profit generation over time. A key criterion is a low or reasonable price-to-earnings (PE ratio, indicating potential undervaluation. Emphasis is placed on strong fundamental health, including robust balance sheets and sound management. This approach aims to identify quality companies trading below their intrinsic value for long-term gains. A fundamental question for legendary investors is central to company valuation. This core inquiry focuses on whether the price being paid for a company is excessive. It emphasizes the critical importance of prudent financial assessment. The question, "Am I paying too much for this company?" guides investment decisions. This principle ensures that investments are made at a fair and reasonable value. The price-to-earnings (PE ratio) is a key metric used to evaluate a company's stock. A low PE ratio, when combined with strong earnings, can signal an undervalued stock. This suggests the market may not fully recognize the company's earning potential. Investors often seek such opportunities for potential future growth and returns. A low price-to-earnings (PE ratio) often indicates that a company's stock is undervalued. However, a low PE ratio necessitates further investigation to understand its underlying cause. It could signal potential troubles or fundamental issues within the company itself. These issues might include declining earnings, high debt, or poor management. Alternatively, a low PE might represent a market oversight, where the stock is genuinely undervalued. Thorough analysis is crucial to distinguish between a bargain opportunity and a value trap. Trailing PE is a financial metric used to evaluate a company's stock. It stands for trailing price-to-earnings ratio. This ratio is calculated using a company's earnings from the past 12 months. It provides insight into how much investors are willing to pay for each dollar of past earnings. Forward PE, price-to-earnings, is a valuation metric used in financial analysis. It is calculated by dividing a company's current share price by its expected future earnings per share. Unlike trailing PE, forward PE relies on projections of a company's profitability. This metric provides insight into how a company's stock might be valued based on anticipated growth. Forward price-to-earnings (PE) is a key financial metric used in investment analysis. It estimates a company's earnings per share for the upcoming 12 months. Forward PE is particularly relevant for assessing a company's future growth prospect. A lower forward PE ratio may indicate that the company is undervalued relative to its future earnings. Conversely, a higher forward PE suggests investors anticipate significant future growth. This metric helps investors gauge market expectations and potential return. Forward price-to-earnings (PE) is a valuation metric used in financial analysis. It relies on estimates of a company's future earnings per share. However, these future earnings estimates are inherently uncertain and can be inaccurate. Such inaccuracies can lead to a misleading forward PE ratio. Investors should exercise caution when using forward PE as a sole indicator for investment decisions. Future earnings estimates inherently carry significant risk. These projections are based on assumptions that may not materialize. Reliance on such estimates requires a high degree of caution. Unforeseen market changes can drastically alter actual financial outcomes. A common beginner mistake in investing is focusing solely on a low price-to-earnings (PE) ratio. The PE ratio indicates how much investors are willing to pay for each dollar of a company's earnings. A low PE can suggest a stock is undervalued, but it can also signal underlying issues. Failing to investigate these potential problems before investing is known as low PE blindness. Thorough research beyond just the PE ratio is crucial to avoid poor investment decisions. Analyzing a company's price-to-earnings (PE ratio) is crucial for investment decisions. However, A common mistake is to evaluate a company's PE in isolation. Ignoring industry comparison can lead to misinterpretations of a company's valuation. Different industries have varying capital structures, growth rates, and risk profile. These factors inherently influence what is considered a normal or fair PE ratio within that sector. Therefore, comparing a company's PE against its industry peers provides a more accurate valuation context. The price to earnings (PE) ratio is a key metric for valuing a company's stock. However, a PE ratio's significance is highly dependent on the industry context. For instance, a bank with a PE of 12 might be considered normal within its sector. Conversely, a tech company with the same PE could indicate underlying issues, highlighting industry context importance. A common investment mistake is to evaluate the price-to-earnings (PE) ratio in isolation. Ignoring a company's growth prospects alongside its PE ratio can lead to misjudgments. A high PE ratio can be justified if the company demonstrates strong, sustained growth. Conversely, a low PE ratio without accompanying growth may signal a value trap. Therefore, growth must always be considered in conjunction with the PE ratio for accurate valuation. A high price-to-earnings (PE) ratio indicates investors expect strong future growth. When accompanied by high growth, a high PE ratio can be a justifiable investment. This scenario suggests the company's earnings are rapidly expanding, validating its valuation. Such investments are often found in innovative industries with significant market potential. A low price-to-earnings (PE) ratio typically indicates a stock may be undervalued. However, a low PE ratio alone does not guarantee future stock appreciation. When a low PE is coupled with a lack of growth, it signals a potential value trap. A value trap occurs when a stock appears cheap but lacks catalyst for price increase. Such stocks may remain undervalued indefinitely, failing to deliver expected returns. The price-to-earnings (PE) ratio is a fundamental metric in investment analysis. For novice investors, the PE ratio should primarily serve as an initial screening tool. It helps identify potential investment opportunities by providing a quick valuation snapshot. However, it is crucial not to rely solely on the PE ratio for final investment decisions. A comprehensive analysis requires considering multiple financial indicators beyond just the PE ratio. The price-to-earnings (PE) ratio is a key financial metric used to evaluate a company's stock. It is calculated by dividing the current share price by its earnings per share. The first step in PE analysis involves comparing a company's PE to its industry average. This comparison helps assess if the company's stock is reasonably valued within its sector. A PE significantly above or below the industry average may indicate overvaluation or undervaluation. The second step in the process involves a critical assessment of a company's financial health. This assessment focuses on two key areas: profitability and overall financial stability. Profitability analysis determines if the company generates sufficient earnings from its operations. Key metrics include net profit margin, return on assets, and return on equity. Financial stability evaluates the company's long-term viability and solvency. This includes examining debt levels, liquidity ratios, and cash flow generation. The third crucial step in financial analysis involves an earnings growth check. This process confirms if a company's earnings are consistently increasing over time. Consistent earnings growth is a key indicator of a healthy and expanding business. It suggests effective management, strong market demand, and sustainable operations. Analysts examine historical financial statements to identify these growth trends. The price-to-earnings (PE) ratio is a fundamental metric in investment analysis. It serves as an initial screening tool for evaluating a company's stock value. While foundational, the PE ratio is not an exhaustive measure for investment decisions. Further comprehensive analysis beyond the PE ratio is essential for informed investing. A fundamental investment principle guides successful participation in the stock market. This principle emphasizes two critical components for generating returns. The first component involves the selection of good companies. Good companies are characterized by strong fundamentals, sustainable business models, and growth potential. The second component focuses on acquiring these companies at good prices. A good price implies purchasing shares below their intrinsic value, offering a margin of safety and upside. The price-to-earnings (PE) ratio is a fundamental metric used in stock market analysis. It helps investors assess the value of a company's stock relative to its earnings. The PE ratio is calculated by dividing the current share price by the earnings per share (EPS). A high PE ratio may indicate that a stock is overvalued, or that investors expect high future growth. Conversely, a low PE ratio might suggest an undervalued stock or lower growth expectations. The price-to-earnings (PE) ratio is a fundamental valuation metric used in financial analysis. It helps investors assess a company's stock price relative to its per-share earnings. By comparing price to earnings, the PE ratio indicates how much investors are willing to pay for each dollar of earnings. This ratio is crucial for identifying potentially undervalued or overvalued stocks in the market. A lower PE may suggest undervaluation, while a higher PE could indicate overvaluation, depending on industry context. The price-to-earnings (PE) ratio is a fundamental metric in stock valuation. It compares a company's current share price to its per-share earnings. A lower PE ratio may indicate an undervalued stock, suggesting a potential buying opportunity. Conversely, a high PE ratio might signal an overvalued stock or high growth expectations. Effective use of the PE ratio contributes to a more strategic, value-focused approach to stock investment. The price-to-earnings (PE) ratio is a fundamental metric in financial analysis. It helps investors evaluate a company's valuation by comparing its share price to its earnings per share. Understanding and applying the PE ratio is crucial for making informed investment decisions. A proper PE ratio analysis aids in determining a fair purchase price for an investment. Strategic use of the PE ratio can significantly contribute to maximizing investment returns.